But that's why I like real estate investing is like you have not just one method to make income. You have basically four big levers. You got the cash flow, you get the principal pay down, you get the tax benefits, and then you get the long-term appreciation. That's just four. And so, over time, I think if you buy good assets and good locations, you're going to do well if you can hold these assets long enough. All right, guys, welcome to another episode of The Report. Today, we are in the studio and we got a little sunshine outside. And I got a busy week ahead of me and the team. I'm actually flying out to Orlando tomorrow night to speak at my good friend Tyler Devros multifamily event with David Goggins going to be out there and a few other big names. So super excited to connect with Tyler and his team. And then we got another closing early next week. The Bodega Bay 44-unit waterfront hotel got delayed a little bit. We found some water damage when we walked the units before closing, which was supposed to happen last week. So we sent our team up there, remediation team, and sure enough, 7 of the units have some water damage, and so we're going to knock another few $100,000 off the price, and looks like we'll be closing next Tuesday. And for any of you that are interested in a last chance investment opportunities, we do have a couple spots left. You can check out summerscapital.com/invest to get in. That's going to be the last deal on our fund, so super stoked for it. But I'm even more stoked for our guest today. I got someone who's been investing in real estate, multifamily. He's built up a portfolio of over 200 multifamily units by age 32. I got my man, Christian Osgood. Christian, welcome to the show.
Dude, thanks for having me on.
Yeah, dude. I appreciate you taking the time to come on, man, and chat, talk shop with me, dude.
Yeah.
So, you've been on Bigger Pockets podcast 2 times now. You're investing in multifamily, man. Give us a snapshot of what you're doing today in the space.
Yeah, well, we specialize in value add entry level housing. So I do a lot of taking like class F to class C or class C to class B. It tends to be a lot of what we do. But we found like studios, 1 beds with a little mix of 2 beds. That has been the niche in the market that I'm in, where we can just repeatedly do it again and again and again, really effectively. Replaceable parts. I know exactly what to expect in every building. We're a market, a lot of 1950s, 1960s inventory. I do a lot of those projects very consistently. That is probably about 80% of my portfolio. It's going to look a lot like that. Buildings 12 to 40 units.
Okay. And which markets are you guys concentrated in?
So Grant County, Washington, which is central Washington State, Moses Lake, Ephrata, Quincy. If you haven't heard of those cities, that's not uncommon. But right in the middle of the state, cheapest cost of power in the U.S. We have really cheap electric, which feeds manufacturing, great population growth, and a lot of need for renovation. So I do a ton of renovation work over there.
Why is it the cheapest in the country for power?
They have really good hydroelectric. They have the Cooley Dam just a little bit north of there. So they have very low cost of power. There's a time where there's a whole bunch of crypto miners that were going in there when that was the hottest thing. People would buy all the warehouses, cheap electric.
We bought a hotel in December in Lake Chelan, Washington. How far is it from Lake Chelan?
Oh, it's about an hour and a half from Chelan.
Okay. You're south of Chelan.
Yeah.
Okay.
I would actually, every time I go out to Chelan, I drive down to Moses Lake and check out their portfolio.
There's a big popular concert venue out there about an hour south of Chelan.
That's in Grant County. That's in Quincy. Yeah.
What's that one called?
That is called the Gorge Amphitheater.
I want to go out there. It's classic, right?
That's a great place. Funny enough, the last concert I saw there was Kiss.
Really?
They're doing their final tour.
It
was like $15 to see them. I was like, well, I guess we're seeing Kiss in the Gorge.
What was that like?
It was a lot more fun than I thought it would be, actually. They're exactly what I expected.
Yeah.
Which is great.
How's the venue? I hear it's like pretty like mystical.
It is amazing. It looks right over the river. It's right over this huge cliff. Looks out over the river, just big, giant open area amphitheater. It's a really cool space.
Dude, I want to check it out next time I'm up there. Maybe I'll plan a trip to where I visit the hotel and hit a concert all in one weekend up there. We'll see.
Yeah, that'd be a good trip.
So, man, you got started at an early age, dude. I didn't get started in real estate investing until I was 33. How old were you when you jumped in?
I jumped into real estate. My first investment, I was 25, and I bought a condo, live and flip, turned it into a rental. But I really got into investing where I'd count it as like, I bought this property solely to become an investor. I bought a duplex in 2020. I bought a second duplex in 2021, and the same year bought a 38-plex, a 7 and a 6, and got rolling.
Damn, okay. And so from there, you started taking down larger deals. What was the first larger deal that you took down?
The first one was that 38. So my business partner, Cody Davis, I had worked for the Costar Group for 4 years. So they're apartments.com, now homes.com, the Costar data, but basically they have all the commercial real estate data. I'd worked with owners, brokers, banks, property managers to get into real estate. And it net me, after years of doing that job, 2 duplexes. There's this, at the time, 20-year-old in my office who was a broker named Cody Davis, and he got to 30 units. He hadn't actually sold anything as a broker yet, so he had absolutely no money. And I was like, how are you buying real estate? He's like, well, I found someone who'd seller finance me a deal in Quincy, 20 minutes from the Gorge. And the next guy seller financed him another 12-plex in Moses Lake. Same seller as the second deal, did seller financing on a 6-unit. I'm like, so how repeatable is this? He's like, well, if you want to find out, I want to take out a 38-plex. I need a partner to figure that out. That's a bigger building. And so we joined forces, bought the 38-plex, seller financed. I believe it was 4.5% interest, if I recall correctly. $2 million purchase, 15% down. We raised the $300,000 with equity partners. And I mean, that's really the start of it.
Wow.
Big building to kind of get started, especially because it had bad roof, bad electric, a chicken infestation. I'm not kidding. 2 units just had chickens living them. And yeah, there's a lot of rough stuff on it. But it was a project where we took it from 2 million to 3.6 million to 4.1 million over the last 2.5 years.
That's pretty cool, man. My when I first got into real estate investing, I was doing a lot of multifamily stuff. I still own a lot of those properties today, but obviously right now we're doing boutique hotels. But I love that asset class, right? It's evergreen. There's never going to be a replacement for 2 things: a place for people to sleep and a place for people to store their belongings. So that's never going to go anywhere, which I love about that asset class. So my first couple of deals on the multifamily side was C class. These deals had all the problems. One was in Cincinnati. One was a 32 unit in Indianapolis, which sounds a little bit similar to this particular deal. You said it had chickens in the units. Tell me about that, man.
Yeah, so this was an interesting one. It had been in the family. That family had it for the same price on market for about 12 years. So my business partner was 8 when they first listed it for the same $2 million price. They had paid it off because they'd never refinanced it. They'd owned it for a long time, so they just let all the debt fall off it. But they were getting like nothing in collections. So they just had family members living in there, non-paying tenants. People would keep animals in the units. There was a sizable homeless camp on the back of the property that fortunately our neighbors helped us get rid of as part of the acquisition. But there was every problem you can have with the building was there.
Even a homeless camp and chickens.
Yeah.
I've never heard of those.
Yeah, they welcome to Grant County, Washington. No, it's probably the roughest property in that area. It used to be outside of city limits. It's become incorporated, but I mean, that property was super rough. The reason that it worked for us is because smaller investors, your mom and pop duplex, triplex owners, are not going to take out 38 units, and your more established investors who can take on that deal size don't want that much headache. They can take a slightly smaller potential return for a lot less work. For Cody and I going in, where I had a 4-unit portfolio, he had a 30-unit portfolio. For 2 young guys in their 20s, I was like, we can do the lift. We see a path to get this thing to 3.5 million. We blew that out of the water. But we're like, we see a path to fix the collections here, to clean up this property, and to fix everything out of cash flow as long as we can fix collections. It is worth the risk. Let's go ahead and make this deal happen. $300,000 raise, first time ever raising capital. Took 4 phone calls, 3 investors, each came with $100,000. In retrospect, should have found one person for 3. More people is not better for capital raising. But we knocked the deal out, and that was the biggest thing that we did.
That's pretty
we committed
impressive.
And we did it.
He said 4 phone calls, 3 investors. That's you're batting 750, man.
Which isn't terrible.
On a deal with chickens and homeless.
Yeah, I found the larger the capital raise, the easier it is to bring the money in. If it's a deal where other people really wants to be a part of the deal, it's usually a bigger deal. The money's so much easier. Funny enough, Boutique Hotel is the biggest deal price that we've done, $4.5 million. And on that acquisition, I thought I would need multiple investors. The first person I pitched, 7 minutes in, I was like, we need $1 million. I want a minimum investment of $333 from each investor, up to 3 people. They're like, we'd be much more comfortable if it was just us. What would it look like if it was only us? I was like, well, that'd be a check for $1 million.
Yeah.
7 minutes in, they're like, oh, yeah, we're in. And we closed that hotel.
Love that. I didn't know you did hotels as well, man. Where was that?
Yeah, well, I won't do them again. I am not a hospitality guy. That's what I've learned. I was going to ask you about that. So you went from Class C, and you're doing a lot of boutique hotel now. What made you make that swap? Because when I made that swap, I hate running hotels. So I'm
Yeah.
curious what made it
Yeah,
work
so
for
I was
you.
doing a lot of Class C, Class B multifamily, and then in 2021, when the rates were compressing, cap rates were also compressing. There was a lot of buyer demand, and so we were searching for the time, kind of in the southeast. We had just took down a couple larger deals in Greensboro, North Carolina,
Nice.
and
Great
our
market.
co-GPs, our co-sponsors at the time, well, they still live there. Tony and John Azar out of the southeast, are out of Charlotte.
Hmm.
And so we were kind of underwriting deals. Our buy box was really 150 units plus, kind of that CB quality, value add potential, good locations in kind of that southeast region of the country, Georgia, South Carolina, North Carolina, and a little bit in like Louisville, Kentucky. We're looking a little bit of Nashville, Tennessee. So we're kind of looking in those markets. But what we found was a lot of these broker listed deals that were had decent pricing guidances and good locations. They would have a call for offers date, and this was in 2021, very competitive.
Hmm.
And there would be 45, 50 property tours, and there'd be 30 offers on all these properties. And by the time, I mean, some of these pricing guidances didn't even make sense, and they had 30 offers. We would circle back to see what these things would close at, and they would have multiple rounds, best and final. And the groups that were being awarded these deals were overpaying by, $4, $5, $6 million on a, $20 million deal. Like, damn, this doesn't even make sense. You had floating rate debt, the Freddie Mac floating rate, the Freddie floaters back then. When we bought Timber Creek apartment, the intro rate was 2.38 interest only, had a 1% prepay. So it's cheap money, right? So you could overpay a little bit because the rate was so low. But I think a lot of people got caught because the rates went up. And, we actually had to refi out of both of those loans. They were both on Freddie floaters into fixed financing about a year and a half ago, about 5.5 fixed. Luckily, we were able to increase the NOI enough on both of those deals to where we didn't have to bring money in.
Good.
We were able to do a cash out on one of them, return, a good chunk back to the investor. But anyways, so I say all this in that it got really competitive for what we were looking at in that region, right, of the country. And so I was like, dude, I had a co-hosting business at the time, and I was, managing our short-term rentals, but we were also managing for third-party owners in like 7 or 8 markets at the time. And I thought, well, what if we use this management arm to go buy a small boutique hotel? We'll do a self-check-in, self-checkout model with the guests. We'll operate lean. We won't have an on-site manager, and all that payroll will just drop to the bottom line. We'll take that manager's unit online for additional revenue. And we did the first one, beachfront up in Northern California, bought it for 1.5 on seller finance. It appraised 12
Wow.
months later for 4.5, and we tripled the value in 12 months. And I was like, all right, let's go on in this. And it's just a lot less demand on that side versus the multifamily. So since then, we've been buying boutique hotels, but I do love the multifamily and asset class. Still own a lot of multifamily, and do plan on buying more multifamily, at another point of the market, at least for what I'm looking for. I know there's a lot of ways to make money right now in multifamily. At least what we were looking for in that region of the country, it was challenging to find deals to pencil.
Yeah.
That's why I pivoted.
No, that makes sense.
Yeah.
That makes sense.
But I wasn't up there in Washington, so I don't even know that market,
Yeah, we got our resort is on the Hood Canal. So you go Seattle an hour south on the water, foothills of the Olympic Mountains.
Okay.
4.5 acres, 18 individual cabins with hot tubs.
That's sick.
It's cool. It's built in 1934,
Okay.
actually by one of the original Disney set designers.
Nice.
Called Robin Hood Village Resort. The guy who built it was one of the set designers for like the original Errol Flynn Robin Hood movie. But yeah, they're super cool. Cabin in the woods. A couple big A-frames. It's a really, really, really cool.
How did
Piece of
that
real
deal
estate.
come to fruition?
We
Because you're doing multifamily, right? And
Yep.
so to go over to a hotel, how did that idea even come to fruition?
I had a investor friend call and say, hey, I just looked at this cabin thing and I'm retiring and it looks way too active for me. And I was dumb enough to look at it and go, you know what? We've made all of our money by being like willing to do all the projects.
Yeah.
This will be fun. I took all of my best multifamily people because we were small. This is in the end of our first year of buying. We bought 100 units and then we bought the resort. And this is our first year operating. I took all of my multifamily people and I spread them over hospitality and multifamily. I slowed down my entire business by doing an asset that was not what we were the best in the world at. We are good at value add multifamily. We are so good at that. Our systems are dialed in. Our employees are dialed in. and I took that small elite team and I put them on something they had no idea how to do. And it worked. The deal makes money, but we got seller finance terms, very long term, 4.5% interest, excellent debt product. We had a slight overpay for the property because we got excellent terms. We chose terms over price on that particular deal. Only problem when you do that, we decided we don't like hospitality. You can't sell something you overpaid for, even if you have awesome cash flow and great terms. The value is in the terms. We have to write out the deal. It's been a ton of work and a ton of system building.
How are you guys managing it? Self-managing?
So I have an on-site manager who lives on site. It also came with 3 mobiles up the back of the hill. So I actually have a majority of my staff lives on site, which is great. They run it. It's Airbnb style, so everything is self-check-in, self-checkout. But you have a lot of grounds. You have hot tubs. You have unit turns. A lot goes into running a resort. Our first year, we overpaid payroll by so much, having no idea what we were doing. Someone a year later was like, you can do like a per diem. So each cabin has a fixed price to clean. I was like, you kidding me? We don't know that because that's not our specialty.
Yeah. I mean, you can operate it 2 different ways. You can have on-site, or you can have your housekeeping on payroll, which is what we do. So they're full-time, like W-2 employees on payroll. Or you can do third party and pay like per clean. But they say like if you have, once you get north of like 10 units or so, it makes sense just to have full-time on payroll. And then really needs cleaners like 6 hours a day. So I would say the bulk of the check-outs and the check-ins are going to happen within that 6-hour kind of window, the turn of the units. But no, that's interesting. So what's the plan with that asset? You guys gonna hold it?
We will hold it until such a time that we can exit the property. That is one where I'm a big fan of this. I think you find the thing that you're the best in the world at, and you just do that thing. Like, less steps is better. We chose the adventure, and funny enough, we put it on our YouTube channel. We're like, we chose the adventure, and then a year later, like, we shouldn't have chose the adventure. On that one, there will be a point where we exit it. But for the time being,
have you guys tried to sell it?
I've bounced it around. I don't think that we've gotten the NOI to where I would want to buy it, especially if someone was to buy it conventionally. Because when we purchased it a year and a half ago, rates were closer to 5. Like, rates have gone up. Hospitality, banks aren't super hot on right now. And I don't think they're going to be for the next, say, 6 months to a year. I think they'll ease up after that. But just kind of looking at where the market's at, I don't think there's a buyer at a reasonable price based on how we purchased it. It cash flows quite well. We have an excellent debt product. I think the path forward on that one, ride it out for several more years. We pay it down $250,000 end of every year of principal. Equity position increases. Robinhood covers its expenses. Just ride it out, get a little better equity position, probably exit in 2 or 3 years is the play on that one.
Yeah, there you go.
Only way to fix an overpay is to outperform. So we're in that portion.
Let inflation do its thing and pay down principal. But that's why I like real estate investing, is like you have not just one method to make income. You have basically 4 big levers. You got the cash flow, you get the principal pay down, you get the tax benefits, and then you get the long-term appreciation. That's just 4. And so, over time, I think if you buy good assets and good locations, you're going to do well if you can hold these assets long enough. That's the main thing.
Rules of the game for me: long-term, cash-flowing, fixed-rate debt.
Yeah.
If you have all those things, you get paid to wait. And that is the main thing. Is anything goes wrong, as long as you are paid to wait, time will solve everything. You just can't lose cash flow along the way. That's where you lose the game.
Yeah. I think the people that get caught are the ones that, short-term debt, and they don't have a long time horizon, and then they have to refi or sell, and then it's not an opportune time in the cycle to refi or sell. And then that's where you're forced to either sell for a discount, or you're looking to refi, you have to bring cash in, and maybe you don't have the cash to bring in, right? So I think that's where people get caught. So I always say, hey, in a perfect world, you secure long-term debt, buy for cash flow, and buy in a good location. And if you do those things and have plenty of cash reserves, it's hard to lose. But again, I think you got to look at these deals for the long term. You can't be looking at these deals in an 18-year time or 18-month time frame because that's when people get caught.
Yeah. And when we started, I didn't have any money at all. Like there was no money. So reserves were non-existent. As far as I see real estate, I think you have 3 resource pools. You have your liquidity, you have cash flow, and you have equity. You want to build equity as big as you can, but you have to keep everything in balance. If you start without one, the cool thing is each one can be traded for the other. And when you do creative finance, which is like, just defined as anything that's not a conventional go to a bank or buy in cash, it's just figuring out how do I move those three pieces? Because I can trade my liquidity for more cash flow. I can trade my cash flow for more liquidity or more equity. Equity can be sold or financed to the next person. So you can move all these pieces around for a cost. It's just keeping all three in balance. It's basically a board game.
As a busy real estate investor or entrepreneur, time is money and first impression is everything. Every day to make it easy on myself, I wear Built Basics clothing. Whether you're a girl or guy looking for workout gear, joggers, shirts, button-downs, hats, or shoes, Built's got you covered. Super comfortable, tight in all the right places to make you look fresh and clean all the time. Visit BuiltBasics.com and use promo code SUMMERS20 to receive 20% off of your order. Again, that's BuiltBasics.com. That's BYLT Basics.com. Use promo code SUMMERS20 to receive 20% off of your order. Now back to the show.
So back to this 38 unit with the chickens and the homeless camp. How did you guys treat that? Because, I know taking over these multifamily properties with a lot of issues, like the 32 unit building we had in Indy, it had hookers, prostitution, drug dealers, and it was a heavy lift, kind of turning over that class of tenants. What was that like for you guys?
We had an advantage with the timing. This was right at the rent moratorium, so there were a ton of programs for all the non-paying tenants to help get them caught up, which helped immensely. When you're starting with no money and you get like 6 months of rent from the government for a ton of non-paying tenants, we were able to come in, renovate units, start getting we got kickstarted by stupid government policy. So that was nice. But outside of that, it was like, okay, we have to be really present there. I mean, we were thinking of anything we can think of. Like, how do we change the energy of a property where everyone's been trained not to pay? We made a show of, as soon as we came in and got the check from the government, I was like, everyone with a maintenance request. I'm like, do you have a fridge, a stove, a busted toilet? What do you have that we can fix? And I just made sure we did it middle of the day. All the fridges get rolled in at the same time, and all the stoves, and the tenants can just see instantly. They're not the most expensive renos, but it's like tenants can see instantly there's new management and they're treating this place differently. That made a difference. That of all the non-paying tenants, we had like 20, almost half of them started paying. As soon as we put in some effort, they reciprocated, which was great. We had a few drug problems there. It wasn't as bad as I thought it would be. I actually underwrote it to be a lot rougher. There were 2 really scary tenants in different units. It took about a year to figure out how to get them out, especially Washington State. We're not a state where you can just haul people out. It's a long, expensive eviction process, even when they haven't paid. But through the course of a year, we did eventually get both out, renovate both units. It was just a slow, steady process. Consistently over there twice a week, 3-hour drive from where I live, but drive over the mountains. We're there on site. I started a property management company, which I later bought my partner out of. So it's currently just my property management company. But we built that company primarily to handle this property and a couple of other small properties we'd owned at the time.
I think doing it that method is good. And then self-managing, I think, is also huge, especially out there. I mean, I don't know what third party looks like out there. It sounds like more of a rural area.
Not good.
Yeah.
I would not recommend anyone starts a PM company. It is
here's the thing.
Low margin, high risk.
Here's the thing. With a 32 or a 38 unit building, you're too small for on-site management. Yep. Typically on-site management, you need to be 100 units or north. You can maybe justify 80, but 32 units and 38 units, it's not enough. And so now you're looking at a lot of like mom and pop type of property managers that maybe manage single families, and they might manage some small multis, but they're not going to be as savvy or sophisticated as these PM companies that manage 100 unit assets. And so that is the challenge. And without on-site, it was hard for us to lease up units. So when we're doing these turns, it was challenging. And so what we did, we had to pivot, because we would test the property management company, would like shoot them an inquiry on their website about leasing out a unit, and they wouldn't respond for like 4 or 5 days. Well, people are looking at touring units. That's not going to work. Yeah. Right. You're going to lose that lead. So we pivoted, and this worked really well. So we actually we used Facebook Marketplace, and we started marketing these units on Facebook Marketplace and Craigslist on our own.
That is the magic right there.
Yeah, it is the magic. Facebook Marketplace is massive for leasing out units. A lot of property management companies don't do that. but you can as the owner or the asset manager. And then what we did was we called a local real estate agent that was in the area. This is a town 15 miles south of downtown Indy called Greenwood, Indiana.
Yeah.
Good submarket. Schools are like 6s and 7s.
Nice.
Just a good like blue collar, white blue collar type of like town. Median household income $60,000. But we went on Zillow and found like Zillow agents in the area, and we hit up like 4 or 5 of them. We said, hey, we own like a 32 unit multifamily deal in Greenwood. We're leasing up a lot of like newly renovated units. What are the chances you could tour these prospective tenants and we'll give you a commission? And one of them was like, yeah, I'd love to. I live a mile down the road. And so she ended up, basically leasing up all these units for us. We would take the leads from Facebook Marketplace,
Yeah.
Craigslist. We'd feed them to her, and she would go walk the properties with them, and she would like close them. And just that one simple move allowed us to really drive occupancy and push rents because of it.
Yeah. In PM, it's not harder to be better than the other person. Like the biggest property manager in town for that type of asset class was the one who was currently managing that building. And they had like 7 paying tenants. Like it was kind of a disaster. So when we came in, I was like, okay, well, we can't use a third party because that's just, they're all not going to work. Exactly like you said. The building is too small for on-site and too big for a general PM to be any good at it. What we found that works is any building 12 units and up, you need a key tenant there. Ideally a handy person, but someone who can be your eyes and ears at the property. So we try to spread out our best tenants. I buy a new building that has like an awesome space in it. I make sure that one of my best tenants from somewhere else is put into that building, and they're my eyes and ears. So I have people I can trust. Then decentralized property management. I go, okay, we invest in these 3 cities. They're right next to each other. My staff lives right in the middle of that, and they can go to each and every property. So I basically treat the 200 unit portfolio kind of like you would a building with an on-site manager, as close as you can. As you go, okay, let's get eyes on all the properties. Let's get cameras on all the properties. And then let's have a 1 or 2 person staff who can service just these buildings at all times. And that worked really well for us.
I love that. That's huge for a lot of things, but also just kind of keeping the grounds clear too. If you don't have on site, trash gets left in the hallways. The landscaping can have trash out there, and just things that just really don't help like the overall appearance of the property. And that's huge for people that live there, people that are driving by. And so having someone like on site that can do all that stuff is huge. How many units do you guys have just in that area?
Just in that area, it's going to be a little south of 200 in that area. A vast majority of my portfolio is there. I also own some in Texas. We own a little bit on the other side of the state. We just picked up a mobile home park for the first time that we're figuring out.
Good, yeah. Okay.
Which feels a little bit more congruent with entry-level housing than jumping into boutique hotels for me. But yeah, for the stuff that we do, it's going to be a little south of 200 units. We manage third party, not a lot of it, but some. I think in that town, we manage about 260, 270 units.
What is apartment rent for, like a 1 or a 2 bedroom rent for up in central Washington?
For entry-level housing, for the type of stuff that we rent, 1 bedroom would probably go for $975 most places. You might be able to get a little north of $1,000 depending on what side of the street you're on. Studios don't rent a lot lower, but maybe $875.
Okay. And you have 2 bedrooms as well?
Yep, I have 2 bedrooms. If you have some of the nicer ones, like new build stuff, is going for about $16 a month, and that's near my stuff. Ours is renovated 1955. There's a huge difference between old renovated and brand new build.
Okay, so Class A is like $1,600 for a 2 bedroom.
Yeah,
and then you guys are what?
And then on a 2 bed, we're probably coming in like $1,250.
Okay,
and I like to stay a little under market rent. I love doing renovations like this. It's called functional flipping. We go into it. I use basically the same floors, glue down LVP for everything. I use the same wall paint for everything. We use the same countertop. We use the same appliances. Every unit looks pretty much the same across the entire portfolio, which has some huge efficiencies for us, which lets me keep the price down a little bit, which lowers my vacancy because I can renovate things in bulk, which cuts my price, which means I just have nicer units than my neighbors for a lower cost, and I can keep my rents $50 under theirs and have a better building. And that has helped our vacancy tremendously. We're basically 100% occupied at all times.
Wow, that's really good.
Yeah. Unless we're doing a huge reno. Like we're doing a couple of hotel conversions, taking a 32 unit hotel to multifamily right now. Obviously, when you're doing hotel, it's mostly vacant because we're mid renovation. But once we're done with the project, we're usually 3 to 6 months to get fully leased up, and then we stay 95% plus occupied.
You mentioned collections was an issue when you bought it. Is that still an issue?
Not on that property. I just had a non-pay for the first time in a while, and we were about to win the eviction. We're still undefeated on evictions, even in Washington State. We've done a few. And they were able to qualify for a government program. We were able to work with them. They got caught up on rent, and they're back in good standing.
What's the eviction like up in Washington?
It's going to be $3,000 to $5,000 per eviction, about a 60 to 70 day process, and the tenants gets free legal representation. So that is, and those lawyers are good, dude. They get like the best lawyers for free. It's
So you're
hard.
better off doing like a cash for keys.
Cash for keys is always better. Most of our tenants, I have found that only maybe 25% will accept it though.
Yeah.
I have not had great luck with cash for keys. Some do. I had one lady though who did like $30,000 of damage to our roof with a shovel. She then broke into another one of our buildings and ripped off all the trim. And then when we went to evict her, her lawyer invoiced us for renovations done to our buildings. That's how they categorize that.
Wow.
And they're like, well, let's pause this whole process for 2 weeks to do an investigation to see. I was like, you gotta be kidding me. Washington is a horrible, horrible landlord state, which does have opportunity though. I've never heard of someone from Texas who wants to invest in Washington, but everyone in Washington wants to invest in Texas, for example.
Mhm.
You have less competition because it's harder. I have found that the deals are easier to do there because it's
So
like,
it's like
who else is going to do that 38?
Yeah, it's like California, for example.
Yeah.
People that don't live in California, they don't want to invest here. Landlord tenant laws are like, it takes 6 to 8 months to evict someone. In California, you don't own your real estate, and it's tough. And so, people that don't live here, they don't want to invest here. But for the folks that live here, I mean, shoot, I don't think there's a more time-tested real estate market than a lot of the coastal California stuff in terms of like long-term appreciation. The stuff here just doubles every 12 to 15 years like clockwork. And
That's the thing with California.
again-
We're down
again,
here
you
in
gotta-
San Diego. It's beautiful.
you got to live here to understand it.
Yeah.
So I get it. I think investing out of state comes with a little bit of risk. And so if you're going to do it, I think that's why people tend to go to like more landlord friendly states. It's a little bit easier, and that sort of thing. But yeah, it makes sense. I mean, I don't have a huge appetite to invest in Washington. We bought that deal in Lake Chelan just because we have a good relationship with our lender, and they took back this asset. We ended up getting a really good deal on it. Like we'd be dumb not to buy it, so we did. But otherwise, no, I don't think I would have had an appetite to really go in there. But sometimes you get a good deal, and it's hard to say no.
Yeah. Chelan's a cool place too. That's a really cool place.
You go there a lot.
I don't do a whole lot of boating, but I have some buddies who maybe every other year will rent a boat and we'll run around the lake. I mean, it's just beautiful there in the summer.
Yeah. We bought this asset 2021 construction, so almost
Oh,
now,
wow.
40 units in the Manson Bay area of Lake Chelan. A lot of cool wineries up in the area, but it was called the Manson Bay Suites,
Yeah.
and we're rebranding it to the Lake Chelan Lodge.
Oh,
So,
there we go.
Yeah, excited for it. We're gonna put a couple pickleball courts in and deck it out. But busy season's about to start here in about a month or two, so excited for that, and we'll see what it does. Yeah.
If you want to have a hospitality project work, add pickleball. That is the formula, man.
It's a trending sport, man.
Dude,
It's a trending
pickleball's
sport.
best.
It
That's
is.
the
It
game
is.
of champions.
So you mentioned that you broke up with a partner with your property management company. Why did you break up with your partner?
We had different goals. And so I have some rules of partnership. And my business partner, Cody Davis, we're still partnered on a lot of stuff. We've had a couple of rules that have worked really well for us. One, you set a goal for every partnership and you just don't renegotiate anything until you hit that goal. Because there's no such thing as an even partnership. Like people have different skills, people have different goals. It is impossible to be 50-50 and be exactly 50-50 in everything. It just doesn't happen. People are people. So what we did is we set this goal of we want to hit 100 units. Cody wanted to retire his mother. I wanted to retire my wife from teaching kindergarten. There's the two goals we had. I'm like, okay, well, conveniently, they cost about the same. So let's go get our 100 units, and then let's look at where we're at. And after we hit 100 units, we looked at the portfolio, and Cody's like, I don't like managing these. And I'm like, I do more of the work. I would rather have the equity in this project. Cody's like, well, I helped get him out of a partnership early in his career that kind of went south. I bought into a building that used to be his and his partners. He's like, I would love to own that building by myself. That all we had to do to fix the partnership was, I'm like, you want real estate a little bit more than I do. I want this company and our employees more than you do. I will trade you my equity in your sixplex for your equity in our property management company. Solved, perfect. On to the next project. We scaled up to 200 units together right after that.
Nice.
And we've done that before. We've traded buildings. We've traded companies. I'm building my my house in Texas. Has been a lifelong dream of mine. I traded him a few buildings to have some more liquidity. I don't want small properties. He wants to do some micro developing. Developing doesn't interest me personally. I love renovating. I love imagining what a property can be. Ground up, not exciting to me. So I gave him all of our properties that have a little bit of land on him where he can build 7plexes and duplexes. He gave me cash. I'm building my dream house in Texas, and I'm keeping all of the larger properties, the 38plexes, the 32s. You just adjust the pieces, but not until you hit the goal that the partnership's laid out. And that's worked really well.
Dude, that's interesting, man. I've never heard of someone doing that. You guys are trading real estate like Monopoly.
Well, we never have money. So we have cash flow, but man, we have liquidity, and we turn that into a building so fast. And we love doing rental projects. I always have more real estate and more cash flow than I do liquid cash. And so when we go to trade things, you look at your resource pools, and it's usually like, okay, yeah, I have some buildings you want. You have some buildings I want. I want to do this project over here. You want to do a different project than we originally wanted to do on this thing. Just look at the pieces, communicate well. I mean, I think that's all partnerships come down to that. It's like, communicate really well what your goals are. Sit down at the table over food and go like, okay, here's what I'm happy about. Sometimes there's like stuff that we're just not happy about. I'm like, here's what I don't like in our partnership. And we sit down as friends and we go, how would we fix it? And then we trade pieces and we fix it and we move forward. It's worked really well.
Your biggest partner in a real estate deal is always your lender. For me, I prefer using someone I know, like, and trust, whether you're looking for commercial loans, residential loans, bridge loans, DSCR loans, no debt to income ratio, no tax returns. My guy, Chris Groves, has got you. As seen on episode 77 and episode 142, Chris is a good friend of mine and is doing a special offer for podcast listeners, $2,500 off of your closing costs and or appraisal fees. Visit grovescapital.com/Rich Summers to book a free call. Again, it's grovescapital.com/Rich Summers to book a free call. Now back to the show.
That's cool, man. That's cool that you guys, are still working together and that sort of thing. I think most partnerships break up for different reasons, and usually the bridges are burnt, And I can resonate with you. I had a couple of old partners that I still own real estate with today, but we had a successful partnership, man. We were all working, the three of us, as air traffic controllers, and our goal was to get out of the air traffic stuff and into real estate full time. And we successfully did that, bought a bunch of real estate together, and still own a couple assets with them. And we have a great working relationship together. I was just on, it was actually my old podcast, but they still have it. When we split up, I said, you guys keep the podcast. I'm going to start my own. And that's how this one was born. But they actually had me on their old one not too long ago. And actually, Mike Ty, one of the partners, he's going to come on next week. So excited for it. And they're good dudes, So similar to you and your partner, it's like when you break up with people, man, like, I don't want to ever burn bridges with anyone, because you never know, when those might circulate back, or, what opportunities those relationships might lead to down the road. But I don't know. I just never see the need to burn bridges with anyone,
Yeah. I've had partnerships that have gone sideways where it's just like, I'm like, well, this is done. And those are never fun. Like sometimes you do hit a point where it's like, wow, this is just not going to work. And that
Well, here's the
sucks.
thing for me, man. I was like, okay, well, am I going to reach my full potential in this partnership? And the answer was no. Our partnership was interesting because there was three of us. Most partnerships are two, but there was three. So, every decision was a majority vote. And since they were kind of batting on the same team, a lot of my ideas, and I'm like a visionary, right? I think that's where I bring a lot of value. So a lot of my ideas would be like, not considered, And so I felt like I would never reach my full potential under the structure because none of my ideas would ever come to fruition. You know what I mean?
Yeah.
And so I had to cut it, but I would say I've grown more in these 18 months since I've been on my own than I did, for a long time before that.
That's a good message for those listening. Partnerships, they're not necessarily designed to last forever. Marriage, try to make that one last forever. Outside of that, just set a defined goal and then like hit that thing and just look at the pieces. Because generally speaking, people are variables like debt. It's really hard to work with variable stuff, especially when you have a singular goal. You're going one direction. People are one of the hardest pieces of real estate. So if you can keep those with defined boundaries and defined objectives, it's going to make your investing career a lot easier. And knowing when it's time to communicate to everyone, like, hey, I'm trying to go here and you guys are trying to go here. What would this look like? And it sounds like for you guys, they got the podcast, you went on and did your own thing. Like that sounds like it was a pretty good split up.
It was clean. We had a meetup, but it was really like a meetup that I was kind of hosting, and so I said, hey, I'm going to keep the meetup. You guys take the podcast, and here we are. But I think my biggest takeaway looking back, man, is everyone's going through partnerships that break up. It's just part of the game. You talk to a lot of entrepreneurs out there that are up above me and ahead of me. A lot of them will tell me, man, like, hey, we cut partners all the time when it's no longer aligned, and it's okay. It's part of the game. It's part of the journey. And so I think, for anyone out there that has a partner that doesn't feel aligned anymore, like you're not alone. That's normal. Like people cut them all the time, and if it's not aligned and you don't feel like you're going to reach your full potential, man, life is short. So why not do something about it now?
Yeah.
And also I think, if you're disgruntled in a partnership, it's like you're not going to be the best version of yourself either.
No.
And that's not fair to your partner.
No, those get miserable. I think that's the worst partnership, when one person's unhappy and they don't say anything about it. Stuff doesn't get done. Things fall through the cracks. Everyone's bitter at each other. People start doing secret side deal. I've seen all of it fall apart. I've seen some $100 million partnerships. I mean, the hundreds of millions in assets owned by them, not like syndicated. Like it's just they are the owner. And I've seen some of those fall apart over like $1 million. And it's like, wow, that is terrible. And you learn the backstory. It's like, oh, you guys have hated each other for like 10 years. You never did anything about it.
Yeah,
you don't want to be in that partnership. Set those boundaries early and evaluate often.
Yeah, I agree. So you mentioned you guys took down a mobile home park or two properties.
Yeah, we did two recent transactions. Funny enough, I've done almost everything with seller financing. I don't target seller financing, but I do try to find people who've done what I want to do. And I find that's usually investors who own a lot and have owned it for a long time, which means they have high equity. So I've done a lot of seller financing lately. Both of these last two transactions were hard money because we won on price by a ton. One was a 28 unit mobile home park, technically an RV park, but they're all long-term rentals. So it's really effectively more of a mobile home park. That's what I'm calling it. We bought that on the water for $375,000.
Wow. How many pads?
That is 28 pads.
28 pads and on the water where?
Hood Canal, really close to my resort.
Gotcha.
It's about 20 minutes down the road.
Okay.
That is an excellent deal. The only thing with it was it had a failed septic drain field, so septic needs to be redone. We budgeted for 120. It looks like it's going to come out closer to 70, which is great. So it should get that all fixed. But I mean, we went on price by a lot. Stabilized, I'm thinking it's probably closer to $1 million. Rents are pretty decent out there. So that's one project. Then the other project we did simultaneously was the hotel conversion, that 32 unit I just mentioned. That one came half rented, and they'd already been doing long-term leases in there. So half the building's rented. It needed a new roof and badly needed new paint. And at some point we'll need new electric. So it had some pieces to it, but 32 units for $1.6 million. Downtown core, 2-story walk-up, paved parking. I'm like, I'll do that deal all day long.
Downtown core, which city?
That's Moses Lake.
Moses Lake. Okay.
Yeah, so that's right in the core downtown area.
Doesn't Boeing have a big plant out there at Moses Lake?
Yeah, it does a lot of its R&D and testing up there, but they also do manufacturing. That's actually closer to my 38 plex, but yeah, that's probably about 20 minutes outside of downtown, right up the highway there.
Really? I didn't realize Moses Lake was so close.
Yeah, Moses Lake is interesting. People don't know this about the town. Biggest employers there are Microsoft, Boeing, and Amazon. They again, cost of power. You have all the data centers out there. So there's a ton of data centers from Microsoft, Boeing, Amazon.
So Boeing Field is in Seattle.
Yep.
And then Moses Lake, you're saying is 20 minutes away?
No. So the Boeing Field for Moses Lake, because Moses is about 3.5, sometimes 4 hours out of Seattle.
Oh, shoot.
Central Washington. Okay, but they have a large facility there for Boeing. Boeing has a bunch of different manufacturing. They actually have one right next to my house in Renton, too. We build planes downtown Renton as well.
Dude, I love that, man.
Yeah.
I love that.
Boeing's a big employer for Washington.
So with this hotel conversion, is there a lot of bureaucracy that you got to jump through to get the conversion?
Not as much on this one. So, there's like 14 other hotels that did the same thing. You talk to the city, and the city wants you to do a bunch of absolutely crazy nutso stuff to get your multifamily designation. However, there's no limit on how long a guest can stay. So you can run them as long as you want to lease them. They're just essentially month-to-month leases. We learned recently they also can't stop you from doing a 6-month hotel stay. So we have 6-month leases on a hotel. It's a designated hotel, so it trades at a lower cap rate. But on a cash flow standpoint, I can pay hotel pricing, but I have the stability of multifamily in these. And the city is fine with that, and there's nothing they could do if they weren't fine with it.
Got it.
Which is great.
So but you guys are in the process of getting the zoning changed?
I don't think I will on this.
You're not
I
going to?
originally thought I was going to,
Yeah.
but the city, it wasn't super unreasonable on the first one we did. We did this on a 24-unit hotel as well. On this second one, the city went, we will let you switch to multifamily as long as you completely raise the building and build a new building with ground floor retail. I was like, well, do you know what's definitely not happening is that. So we're just going to run it as a hotel, and that's fine. It's a hotel with long-term stay. They're like, isn't that multifamily? I'm like, I don't know. Your rules say it's not. So
Do the units have kitchenettes?
yes.
No, that's good.
Yeah. So yeah, simple project. You find one, kitchenettes are the big thing in there. And you want stuff that's grandfathered in so that you don't have to add sprinkler systems. That's the one thing that gets really expensive that I've seen people not factor for.
I know with like hotel lending in core primary MSA markets,
Yeah.
you'll get better terms and a little bit higher leverage because these lenders know you can always convert these hotels over to multifamily, and there's going to be a demand for it, especially in these big markets. So it takes a little bit of risk off the table for the lender, but yeah, I mean that's interesting because I do see a lot of hotels out there that are sitting on LoopNet for 365 days, and typically got kind of like monthly rentals, more transient or even weekly, but long term guests, I guess you could call it. But after 30 days in California, they got tenant rights.
Yep.
Yeah.
And same in there. So the only way to keep their tenant rights from reactivating is like every 3 weeks.
They gotta
move them
leave.
to a different room. But that's way too much of a hassle. So
Yeah.
they're all, no matter what, they're going to have tenant rights. They're in there. The project is the project. But we were picking up multifamily. If it's value add, I'm usually, if it's $100,000 a door, generally speaking, it's probably going to work. For my team, I can fix up a building. There's few problems I can't fix where that valuation works.
100 a door is a good deal out there.
100 a door is a good deal for me on a project where I know there's going to be some fixing up to do. Because I can pick it up there. I definitely get a cash flow, even if it's all studios. They work there. The hotel rates, I'm picking these up closer to 55 a door, and I'm doing the same project with the same cash flow, or not same cash flow, but the same income. So the cash flow is astronomically higher. So whether you get the conversion or not, there are deals where you can buy them, you can hold them. There are lenders who will lend on them, usually at a little higher rate, but they'll still lend on them as if it was a multifamily property, still with the hotel zoning. They'll just add a point or two to it. It's a strategy that's worked well. And again, it falls in our bucket of entry-level housing. You get studios, kitchenettes. That's not that much different from a multifamily building with studios and ones.
Yeah. I love that, dude. So with the mobile home park, and then you get the hotel conversion, you guys are buying multifamily out in Texas now, I believe. What do you guys mostly focus on for the rest of this year?
Rest of this year is all about stabilization. We did a huge build phase of like, let's just buy because did not have enough pieces on the board. I've been really playing the game for 3 years. Bought a few properties before that, but we've been playing the game 3 years. All we focused on was let's acquire this stuff and make sure it cash flows. I just finished a roof on another building, just finished some electric upgrades. We're doing the septic system. So we're getting through the final projects of everything we purchased originally. Then we're going to go back through the portfolio and we're going to optimize. I think there's 4 phases to business, at least in real estate. You have the build phase, acquire what you need to hit your goal. You have stabilize, make sure you're at 90, 95% occupancy, no major deferred maintenance, you're cash flowing on every individual project. You have optimize, where it's like, okay, let's get the best paint colors. Let's get every little thing fixed. Let's make sure all the windows are up to date. I mean, like, the building is done and the cash flow is maximized. And then stage 4 is pay off the debt. And we're not there yet. I've paid off I've paid off a land parcel and we're starting to pay down some things. But at some point, I want to build it to where we build all the cash flow and the cash flow pays off all the debt. And we just have this huge debt-free portfolio. Not the best tax strategy, but damn, it would feel good to own it all.
Yeah. No, I hear you, man. I hear you. That all makes sense. And, I think sometimes, it's all phases, like you said. You get in the game, you're acquiring a bunch of stuff, and then it's like, okay, well, this feels uncomfortable. Now let's stabilize everything, and that gives you another sense of comfort. And like you said, I think the ultimate sense of comfort, if that's what you're looking for, is to have no debt, and there's nothing wrong with that strategy.
Hard to lose a paid off property.
Yeah.
It's like pay your taxes and you're pretty much good to go.
Yeah. Now, from a return on equity standpoint,
Not
you
the
can probably
strongest
find
strategy.
better by re-leveraging a lot of that equity. But there's nothing wrong with, buying a handful of assets, paying them off, and living a comfortable life. That's totally fine too. And that's an investment strategy that some people have, and I can't hate on it.
And I want to do it in phases. The first one was we bought that first 100 units that bought Cody and I financial freedom. All those units cash flow, they do quite well. Pay that whole block off. Now that's even more cash flow. We're beyond, comfortable standard of living. Now, most people could retire there. I'm like, okay, well, while we're doing that, let's start build phase part 2. And we're acquiring that block of properties while we're paying off the first one. And now we have 2 paid off blocks of properties. And then you lever up again to your 1,000 units and you figure out how to pay those up. But it's like, how big can we get a paid off portfolio? Because without debt, you can move your pieces around very freely.
But you know what's going to happen, dude, is you're gonna get to a point where everything's stabilized, and you're gonna be like, what's next? And you're gonna want to buy more. It's just the nature of the game, man. Because for a lot of us, happiness stems from growth and progress. And so you grow, you feel a little overwhelmed. You're like, hey, let me stabilize everything. Everything gets stabilized, and then you're like, okay, I'm bored. What's next? And then you want to grow again. That's what creates happiness for a lot of us, especially entrepreneurs and real estate investors. So what you think you want today is going to be different when you get there, is what I'm saying.
Yeah, no. The fun thing with leverage is you can always re-lever on the new stuff, right?
You
You can
can.
always add leverage by acquisition.
Yeah.
Our method to pay off stuff is just don't re-lever. The guys we learned our whole strategy just by interviewing people who've done what we want to do. Most of the people in our markets who owned a few hundred units had at some point paid it all off. And when I asked them how they did it, they're like, well, a lot of these had 30-year AMs and we just didn't re-lever it and we just let them pay themselves all the way down. So am I going to rush to pay everything down? No, but I am going to let the debt kill itself on the properties. If I want more leverage, I like to stay around 65% LTV personally. 60 is even better, but 60 to 65 is my ideal point. Like, if we want more leverage, I'll buy a new building instead of re-levering the old stuff and let those pay themselves off. And as you grow, you get some paid off assets. I'll always be using leverage and debt, but I'm going to use it to scale up without tapping the old stuff. That's the strategy we're going after.
That's good. I love it, man. Christian, I appreciate you hanging out today, man. Where
Absolutely.
can listeners get in touch with you?
You can follow me on Instagram at Christian Osgood. You can also follow us on my YouTube channel, Multifamily Strategy. Share everything there. We do multiple videos a week. I think we have like 1,500 videos now. That's been a huge passion project for us.
There you go. I love it.
Yeah.
There it is. He's Christian Osgood. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.